Good day, everyone. Welcome to the video of the day. South Korea is up by 80% this year. Taiwan's export at record high. The S&P 500 just had its best quarter in the last 6 years. What about India? The Sensex is still 6.89% below where it was a year ago. The world's fastest growing economy, underperforming every major market. Here's exactly why. There are three reasons. Three forces are hitting India simultaneously, and all three are connected. The first is FII exodus. Foreign institutional investors have pulled out $14 billion from Indian equities since December 24. That is one of the largest sustained outflows in India's market history. Ambit Capital confirmed India's one-year underperformance versus emerging markets is 31%, close to the worst in 2 decades. So why are they living? So higher US interest rates make US bonds more attractive. A stronger dollar market, emerging investments less appealing, and India's valuations are trading at 20 times trailing earnings are simply too expensive. The second hit is the AI rally, which is missed by India. The global AI boom powered South Korea chip makers and Taiwan's TSMCs and America's Magnificent Seven. India has no major AI hardware play. Its largest sector, IT service, is actually being disrupted by AI, not powering it. The third hit, oil import burden. India imports over 80% of its crude, and the Iran war pushed Brent above $96. India's import bill exploded. Inflation surged, the rupee weakened, and the RBI couldn't cut rates. Every dollar oil rose cost India's economy directly. So there is one bull case, and here's the other side, which is very much mattered by us. So Morgan Stanley had a Sensex target of 89,000, implying a 15% rally on current levels, assuming macro stability, private investment recovery, and earnings compounding at 16% by FY29. The good news: Brent fell below $71 after US-Iran war talks progressed, and Iran IT stocks bounced. Falling oil directly helped India more than almost any other major economy. And India's domestic investors, SIP investors, absorbed $14 billion in FII, selling without the market collapsing. Now, the important part of our discussion is the investment angle. So, Nuvama flags market cap to GDP at 130%, well above the 10-year average of 100%. India is not cheap. That's a honest starting point. So these are the sectors with the clearest near-term case. First is banking. Indian Bank and Punjab and Sindh Bank posting double-digit loan growth. Valuation reasonable. Auto ancillaries, strong Q unexpected. CapEx plays, infrastructure, defense, power equipment benefiting from government spending. Even Axis Securities picks 15 stocks for July, up with 43% upside. Bharti Airtel, Delima Bharat, and Intel among top picks. The trigger to watch is monsoon data. We covered the 43% deficit 2 weeks ago. If July rain recovers, food inflation ease, RBI gets the room to leave. So the fastest growing major economy down by 7% in a year. FII is leaving, AI boom bypassing India, oil hitting hard. But $14 billion in FII selling absorbed. Domestic investors holding firm. Oil now falling. Morgan Stanley target is 89,000. The story isn't over. It's just a critical inflection point. Subscribe the channel so don't miss it in the future. Make sure to like it, share it with your friends, family, colleagues to welcome to Money Brief. Let's grow together.